Good day. Welcome to another lesson on our Super Dealmaker Entrepreneurship Master Program. My name is Malusi Makheta, and today we're still looking at the skills program, Finance for Businesses or Finance for Non-Financial Managers. And in that now, it's our last lesson in the skills program. We're looking at how to prepare and interpret the financial ratios. Okay. You know, as an entrepreneur, it's all about how you don't necessarily have to know how to prepare the financials. It might be a little bit technical for you. It's the job of your accountant or your financial manager. But the important part is you should be able to interpret them. You should be able to read, because the financials tells a story. They're just not numbers. I know entrepreneurs use the financials for compliance, for tax clearances. But the financials tells a story. You need to be able to understand what goes on in your financials. It will tell you the performance. You need to be able to see the trend, what's happening in your business, where can you improve, where are you going wrong. Because without you understanding the financials and being able to read the financials, you will not be able to strategically lead your organization to sustainability or to growth. Yes. So for you to be able to read financials, obviously you need to understand the basic on finance. Hence we're providing this skills program, Finance for Non-Financial Managers. So the first thing that you need to understand is your income statement. What is income statement? What is it used for? And if you don't have detailed knowledge about income statement, you can go to our module where we're going through the income statement. It will give you a nice background on what is income statement. But for this lesson, I'll just explain it quickly to say income statement is like your report card for a year. It shows you how you performed for that period that you'll be reporting for. And generally, as I said before, we report for 12 months. So the income statement will show you your business performance for 12 months in terms of your turnover, your cost of operating, your profit. And the main thing is profit, of course, is the bottom line. And for you to be able to interpret certain numbers or to see if you are performing according to your strategy, you need to be able to interpret or understand ratios that are related to the income statement. So we'll go through the different ratios that are related to income statement, like your gross profit, operating profit, return on assets, and all those things. They are certain numbers from those ratios are coming from your income statement. So you need to understand your income statement, the basic knowledge of what is the income statement, or what is it used for, and which figures are important when you are reading the income statement. And then the next statement that you need to understand is your balance sheet. As I said before, if you don't understand what is a balance sheet, or you don't have an understanding, you don't have basic understanding, then go back to the module on balance sheet and just go through the video and the material so that you get the basic knowledge of what is a balance sheet and what it is used for. Basically, a balance sheet it shows you a financial position of your business. And you remember in that module, I equate it to a financial checkup. When you're going to a doctor for a checkup, you just want to see your financial health. Where are you? Where are the areas where you need to improve, or where you're not doing well, or where you need to be cautious or make changes in your life and lifestyle? Similarly, with the balance sheet, it's your financial check. It's a financial position of your business. When you're looking at the balance sheet, you look at where your business is, because a balance sheet takes into account cumulative figures. So it gives you the status of your business from the beginning to the point that you will be reporting. So if you're looking at those numbers, they show you the position. Where are you? Where are your assets? Where are you with your liabilities? Where are you with your equity and stuff like that? So it shows you a position at a given time. So you need to understand the basic and the items that goes into the balance sheet for you to be able to interpret the ratios that we'll be going into now. So you need those basics. And the other statement that you need to understand is your cash flow statement. As I explained previously, the cash flow statement is similar to the income statement. The main difference is that the cash flow only takes into account cash items, money, cash. While the income statement, you also have provisions for non-cash items like your depreciation, provision for bad debts, amortization, evaluation, and all those things. So, but with the cash flow is looking at specifically your cash movement. How are you doing? Are you generating income from your operations? Are you generating income from your investments? Are you generating income from your financing activities? Or how much are you spending on your investment activities? How much are you spending on your financing activities? So it gives you a picture, or the business performance picture. So if you understand the three statements that we spoke about, the income statement, the balance sheet, and your cash flow, then you will be able to understand the ratios, because these ratios are derived from those three statements. So you should have a basic understanding, because the ratios takes figures from the statement and they calculate something that means something. Basically, the ratios are a way of assessing your business performance, your efficiency, liquidity, profitability, and so on. So instead of using the actual numbers, because with the actual numbers, it becomes difficult to see if you are doing well or not. Because with the numbers, it becomes difficult to compare with other businesses. But with the financial ratios, they help you to compare two businesses that they can be of different sizes. But a gross profit is a gross profit. You take your revenue minus your cost of sales, then you get the figure. That figure is divided by your revenue. It will give you a percentage. Let's say it gives you 30%. Big business, small business, you know that maybe in the industry you're supposed to achieve 30%. So you are able to measure if you are in line with your sector or with your industry. And as you grow, you'll be able to see if you are as efficient as you should be. Because when you grow, sometimes business lose efficiency. Meaning, when you're making a turnover of 1,000 rand, you might find you make a gross profit of 30%. But when you are at 1,000,000 rand, you find that your gross profit maybe is dropping to 20%. If you are not careful, you might be losing money in the process. But with the ratios, you will be able to see that, no, it doesn't matter if I'm making 1,000 rand or I'm making 1,000,000. My gross profit is supposed to be 30%. And if you are not achieving 30%, then you know that there might be something wrong with your business or your operational efficiencies, or it might be maybe an intentional strategy where you decided that for you to gain market, you need to maybe reduce your prices so that you can attract more customers. Then that will reduce your gross profit. But if you don't have any specific reason why your gross profit is reducing, then you must investigate to see where are the efficiencies, and you can rectify those efficiencies. So the ratios helps businesses to compare performance, to look at the trends, and to be able to compare themselves with competitors, and also to be able to compare themselves with a large organization. Remember, you have listed companies like your Shoprite Checkers, your Standard Bank, or your Anglo if you are in mining. So those companies, they report their financials, but they don't give too much detail. They give you a summary of what's happening because obviously they don't want to share more information than is necessary. But they give you basic information for you to be able to understand what's going on in that business. Because remember, it's a public traded company, so they need to publish their financials. But they can't give their trade secrets, because if you give more detail on your financial performance, like breakdown of each expense, each cost, and all that, your competitors might see where you have a competitive advantage and maybe adopt the same strategy. So with large organization, they give you synopsis of the financials. They're detailed enough, but they're not too detailed. So they won't give you breakdown of everything. They'll give you revenue, operating cost, net profit, the main figures. But if you understand the ratios, you will be able to read those financials and get even more information from the little information that they are giving you. And you can use that information to assess your business, to say, obviously, when you're running your business, you want to be as efficient as possible. And we know, like, your large corporates are very efficient. They have systems and all that. So your intention should be to perform better, or maybe equal or better than those large listed institutions. So for you to compare yourself, the instruments that you can use are your ratios, because figures you wouldn't be able to compare, because they're making their turnover in billions, you're still in thousands. So you can't compare your revenue figure to their revenue figure. But for instance, you can compare your growth. Let's say year-on-year growth. You look at, suppose you are in the same industry. If they are growing at 10% and you are growing at 5%, you will know that there's something wrong here. There's something that you are not doing right, that the big institution is doing. So the ratios helps you to be able to compare with the best in the industry, so that you can improve your performance. So, but you need to understand what is in that ratio. How can you use it? What does it mean? Which figures are they using to calculate that ratio? Because in their financials, they will show you maybe growth percentage. You need to know what is a growth percentage. I mean, a simple growth percentage is the difference between your revenue from last year and the revenue from this year, or from the previous period to the current period. You take the difference and you divide it by the revenue from the previous period. Then that will give you a percentage of how your business grew in turnover. Then if you have the growth, let's say your growth is 10% or whatever the percentage is, you can compare it with the similar organization. Let's say you are a spaza shop. You can compare your growth with Woolworths, for argument's sake, or ShopRite, Checkers, or your Pick n Pay or your Spar, because their financials are public. If, let's say, you are in mining, you can be able to see the growth comparing your financials with Anglo, because they need to publish their financials. You will be able to see their growth. And as a business, you will be able to see, how did my business grow compared to the large organization? You see how important the ratio is. And if you can have access to your competitors' financials, okay, I know they are private companies and you're not supposed to. You shouldn't get them illegally, of course. But if you happen to, you will be able to see how much did they grow by compared to you. How much did your business grow by? And then as well, there's also like your industry data. We find that they say food basket has grown by this percentage from this year to next year. So if you see that growth, then you should be able to compare it to your growth as a business. I mean, food basket is like they take basic commodities that are consumed in an average household. They see the price from last year compared to the price in the current year. So, and then they see how much the price has grown by. So if you are a spaza shop, obviously you are selling basic consumer products. So what you should be able to do is say, okay, if the food basket has grown by 10%, for argument's sake, how much did my revenue grow by? If your revenue grew by less than 10%, there's something wrong there. It's either you're not adjusting your prices according to the market, or your revenue is not growing, you are losing customers. So you need to go investigate what's happening. Because without you measuring your growth and other ratios, you might not realize that you are in trouble until it's too late. So the ratios help you to analyze what's happening in your business. Where are you having problems? Are you having challenges with maybe customers, growth, efficiency? So by looking at your ratios within your business, you will be able to interpret the financials to see where the business is going. Are you losing market share? Is your business growing in line with the industry? Are you performing in line with the industry? Because without doing that, you wouldn't realize that your business is failing. So the ratios help you to check your business and navigate the challenges that those ratios will be showing you. So they are very, very, very important. Because without you preparing the ratios and understanding which key ratios to use in your business to assess the performance, then you will realize that you are failing when you see the actual numbers. It might even be a year later. When you see your income statement compared to last year, you realize that no, the turnover is less than last year. But it's a year later. But if you know the ratios to say, I need to achieve a month-on-month growth of, let's say, 5%. Then if you are not achieving that, you will be able to identify it early and take corrective actions to make sure that you adjust your whatever it is. You go to the root cause and then you fix them. We fix those problems before they fix you. Because without that, you won't be able to see your problems early. So the ratios are called, as well, sometimes they give you early warning signs. Before the reality hits, the ratios would have shown you the warnings. So you need to be able to understand which ratios are important in your sector and where are they. Where is the sector? Which ones are important? And where is my sector performing? And again, you should be able to read other economic data so that when you interpret your financials, you are interpreting them in line with what's happening in your sector. It's not in isolation. They should be, the industries are integrated, is one thing. It doesn't matter if you're a spaza shop or you are a wholesaler or you are a large supermarket. The industry is the same. The growth in the industry will follow more or less the same trend. Unless if you have individual problems as a business. And as I said, the ratios are there to guide you, to help you identify issues early, and so that you can fix them and improve. Remember as well, sometimes you target certain ratios to say, my target is to grow my revenue or my sales month on month. I want to grow it by 5%. And if you are not growing by 5%, you are able to go back to look at your strategy to say, where can I fix? Where am I going wrong? Then you try to fix and you see next month if you are achieving your growth. That's how you're supposed to use your financial ratios. All right. So in this lesson, we're going to look at, call it maybe top 10 ratios, but remember, I just generic top 10. Different industries they're interested in different ratios. So, but these ones are what generally a business will look at. These are the ratios that a business will generally look at. We'll look at first, they are grouped in categories. Like you have your liquidity ratio, which measure how liquid your business is. Will you be able to settle your debts? Will you be able to pay your creditors? That's liquidity. Then on the activity ratio, you're looking at the growth, the efficiency. How efficient are you? Like you're looking at your your gross profit, your profitability, return on assets. They'll show you how efficient are you in your operation. And then the third one is your debt ratio. How much in debt are you? How much in terms of the business? How leveraged is the business? Because remember, businesses with high debt, they generally, not all the time, you run a risk of failure because you have high cost of interest that you need to service. You are under pressure from your creditors and your financiers to repay them. So that can put pressure on your business. So that's why your debt ratios are very, very important. And other businesses or other financial institutions, they look at what they call your financial structure. So I know institutions like your IDC will look at to say when they fund you, they want your 40% to be equity and 60% to be debt. So you need to have a 40% structure. Meaning, because they know that if you have 100%, you are funding your business 100% with debt, then your business will be highly geared. Meaning, it has high debt. So if you have high debt, then you need to service that debt. You need to use the money that you're generating to pay the interest. And if you remember, when we were looking at your cash flow, we said your interest is not an operating expense, it's an investment expense. So you don't want to be spending a lot of money on investing expense or financing expense, a financing expense. You don't want to be spending money on investment activities. You need to spend your money on operating activities. So that's where the structure comes in to say, if you're looking for funding, it's even when, without maybe mentioning institution, even for you, when you look for funding, structure your business in a way that 40% is coming from equity, meaning it's what you can put in, and 60% is funded. Because sometimes this ratio, because you don't understand it, it frustrates people, because you go out there looking for money and they tell you they can't find you because your business is risky. Yes, it's risky because you didn't put skin in the game. You don't have equity in there. But if you are setting up a business, I normally give example of spaza shop. I'm not saying you guys need to set up spaza shops, but if you're setting up a spaza shop, when you're doing your business planning, you need to understand that you need, even if you're going to a bank or a DFI, whoever that you're going to associate, make sure that at least 40% of investment is coming from equity, is coming from you, and the 60% is the loan. So start at that level, and then you'll be able to maintain that structure going forward. Because you can start a very big business with high debt, and then you fail to service the debt. So instead of going big too soon, you need to make sure that your financial structure is in place, so that you don't burden your business with interest repayment early on. And remember, with the startup, generally, startups, you start making losses maybe in the first 18 months or so. Generally, businesses are different, and you think your business is the best idea ever. it's going to make profit from day one. Yes, I'm not saying it can't, but I'm just saying generally, startups make losses for the first 18 months. And after 18 months, they start breaking even. And then after that, in the third year, they start making money. So if your business is highly geared, meaning you funded your business with 100% debt, that means even during that 18 months or 18 to 24 months when you are making losses, you still have interest to pay on top of the losses that you are making. So that's why sometimes, like statistically, it's not the only thing that contributes to a small business failure, but that's why you find statistically they'll say small businesses fail within the first 3 years because they don't have enough equity in there to sustain them for these 3 years. Yes, you need to balance your equity and your debt because remember, equity is more expensive than debt. Debt, if you have security and all that, you can get it at prime plus 2, prime plus 5, whatever. But the return on equity, it's higher. It's supposed to be higher. Even if it's your money that you're putting in, the return on equity, the equity is more expensive than the debt because the debt is a little bit more secured. Because in the business, you pay your debt first before equity. So the equity gets paid last. So the return on equity is supposed to be higher than the return on the debt because the debt is paid first. So it's got a lower risk. So it goes the other way. Even if you have money, when you're starting a business, don't fund it 100% using your equity because equity is expensive. You should rather maybe put 40% in your business and the other 60% you borrow so that you reduce the cost of financing. It's called cost of capital. Because without debt, with only equity, the return on equity, you're looking at north of 18% average. General, depending on how risky the business is. But you're looking north of 18%. And the debt, currently, probably you're looking at around max 14%. But with equity, you're looking minimum 18% return. If you're not making 18% return on your equity, then there is a problem. So I'm going to show you the return on assets, return on equity, but these are the basic ratios that you need to look at when you are starting. Is your structure, your capital structure. And once you sort out the capital structure, because your capital structure then it's a fundamental ratio that it can make your business fail or it can make it successful. Or you can make a lower return on equity if you don't structure it correctly. So you must be careful when you're looking at your debt equity ratio and your debt ratio. You mustn't overload your business with debt, but you mustn't fund your business with equity only as well. You need to blend it. Even large businesses, your Englus, your Pick and Pays, they will have debt on their business. You'll be surprised. They have access cash, but they still have debt on their business. They don't take their money and go settle the debt because they know the debt is cheaper. And the debt maintains the structure. It makes the cost of capital lower. So you must be careful when you're looking at your debt equity ratio and your debt ratios. This is the basic the basic reasoning behind these two ratios, that they should be balanced. You should know the industry, what is the expected return on equity. Because if the industry is giving you, let's say 20% return on equity, and your business is giving you 10% return on equity, you rather take your money and put it in the industry and go borrow the money to run your business, because the return that you're getting from your business is lower than the return that you'll get if you put your money in the market. That's the basic concept of looking at your capital structure when you're looking at your debt equity and your debt ratios. Okay, that's on the structure side of the business. Then when you're coming to the side of performance, right? On the performance side, we're looking at your income statement ratios, right? The first one is your gross profit. You'll see how it's calculated. You take your revenue minus your cost of sales, you get your gross profit. And with that, you take that gross profit amount, you divide it by your revenue. And that gives you the direct profit that you're making directly from operations. Before you get into your general operating cost, your rent and all that, that is the top line. To say this business on its own, as a business, as an operating direct operation, this is the profit that I'm making. So the gross profit, it depends from industry to industry. I think in retail, if you are making 30%, you're good. Around 30%, you're good in retail. If you are in fast food, 55% around there, it's a good one. If you're in consulting, we're talking 90%. So it depends on, and as well, if you are buying and selling, whatever, 30% is the average. Like if you're supplying your government and all that, 30%. So if you are in retail, basically 30% gross profit, meaning your revenue that you're making minus the cost of the things that you bought that you're gonna sell. The product, let's say you're buying a product. So you buy the product, you sell it. So the gross profit that you're supposed to be making from that product, if you are in retail, is 30%. It's around 30%, not necessarily 30%. So if you are making anything less than 30% in retail, I smell trouble. There's something that's not going right. And if you are not making, call it around 50 to 60% in franchise or fast food, there might be trouble. If you are not around 60% gross profit in manufacturing sector, things are not looking good. If you are not north of 90% in consulting, then there's something that's not right. So those are indicative ratios that you should know for your sector. So when you're measuring your performance to see how you're doing as a business, you look at the gross profit ratio when it comes to performance. Are you in line with the sector that you are in? If you are not, what are you doing wrong? Where can you improve? Because money is made in supply chain, people. If you don't fine-tune, make sure that your supply chain is efficient, meaning your buying, your distribution, your manufacturing, your transportation, if you don't make sure that there's it's so efficient that you're extracting every cent, then you might be in trouble. So your gross profit is one of the key performance measures that you need to make sure that you monitor. Okay, after now looking at your gross profit and you are comfortable that you are within the industry and your competitors, then you look at your bottom line, right? Which is the net profit margin. The net profit margin is when you take your net profit divided by your turnover. Now that shows you if you are making money, if you are efficient as a whole. Remember, I said the gross profit, it shows you if you're operationally efficient. Direct operation is efficient. Now, with your net profit margin, it shows you that as a whole, the business is performing well if your net profit margins are looking good. If your net profit margins are within the industry, then you'll see by that percentage it will be in line with the industry. So you need to know what is the net profit margins in your industry. Okay, so we know, let's say in retail, we might be talking as low as 5% net profit margins. In fast food, might be talking 13%. In manufacturing, we're going about 15 to 20% net profit, and consulting is the more lucrative one. Can get to your 30% net profit, but it depends on which industry, which retail. I'm just giving you ballpark figures. They're not exact numbers. You need to know what are the net profit margins in your industry. Same as I've mentioned about your gross profit. You look at how is the industry doing, how are the big players in your space doing. If you're in mining, how is Anglo doing? If you are manufacturing, how is Tiger Brands doing? You look at that, but obviously you need to compare with the companies that are in your sector to see how are they doing. What is their net profit compared to my net profit? Am I doing better than them, or am I doing better or worse than the industry? And if you're doing worse than the industry, go look at your operating cost. Let's say you might find that your gross profit, you are in line, but your net profit margins, you are below the industry. Then you know that your problems are in your operating expenses, admin expenses, marketing expenses, and all that. Then you go interrogate those to see where are you overspending. Or you might find that you are doing well on gross profit and you're also doing better on the net profit margins. Still, go back and look. Why are you doing better than the other people? Then that will be your competitive advantage. Make sure you increase on that. Whatever that you are doing right, you improve even further. You even become better on that, so that you increase your competitive advantage. That's how you read the ratios. That's why you need to understand what is the income statement, balance sheet, and your cash flow, so that you can understand these ratios, so that you will be able to use these ratios to strategically grow your business. You can use these ratios to strategically improve your operation. Don't learn or realize that you're not doing well when the creditors are calling, when you can't pay creditors, when the bank balance is negative. The ratios are the telltale signs. They are early warnings. They'll tell you before you even get into trouble that, be careful. Then you can take corrective action early. Because by the time the money is not coming in, the creditors are calling, it might be a little too late for you to recover. But if you read your ratios and you understand them, you might be able to take action before that happens. Okay, that is on the. There are other ratios that you can use on your income statement or on the performance ratios, but these are the two ratios that for this lesson I just decided that I need to focus on these two because they are the critical ones, according to me. And generally, but there are other sectors, different sectors that might be focusing on different ratios. Because let's say even in mining, maybe in the early years, profitability might not be a good measure. Then maybe the measure might be the quality of the ore that they bring up, or the mining rate, or other ratios that they are using. Because at the beginning of a mining company, they might not be expecting to be profitable. So you measuring profitability might be a useless ratio for them. So that's why I'm saying you need to know the ratios that are important to in your sector and measure those ratios. All right. And okay, we spoke about the balance sheet ratios, the debt ratios, debt equity ratios, and their importance. Now we're going to look at your quality or liquidity ratio. They call current ratio, quick ratio, your inventory turnover, and account receivable turnover. Okay, those show you how efficient are you in terms of your operation. So your stock turnover, you need to look at the industry, that if you have stock, how many times are you supposed to turn your stock over in a year? And it depends on the size as well. Because if you look at your Pick and Pay, for argument's sake, your large retailers, you find that they are only turning their stock over 3 times in a year. Meaning, if they buy stock, they will sell it after 4 months. And then they buy another stock, they sell it after 4 months. Over a period of 4 months, not after. Over a period of 4 months, they buy another stock, they sell it over a period of 4 months. That's the stock turnover. That's how they turn their stock. Right. So, the spaza shops, now, okay, just maybe making a comparison with the spaza shops. You find that their stock turnover is 6 months. Because if you go to your rural retailers or spaza shops, you find that they have a tin of fish that has been there for a year. Okay, yeah, I'm a little bit exaggerating, but it's there for a long period of time. And that's not good business. So what these people you need to do if you are running a spaza shop, you need to look at the product that turns over quicker. Yes, you don't necessarily, I'm not saying you shouldn't buy the product that takes longer to turn over. But some, you need them so that people can come to your shop because they need to find what they're looking for. Because if you only have stuff that turns over quicker, sometimes people will say, no, don't go to that shop because you wouldn't find this and this. Go to that one because they always have stuff. So you need to balance the two. You having the stock versus your stock turnover in the industry. You don't have to buy, let's say, 24 cans of fish. You can buy 4 because you know only 1 person or 2 people come in a month to buy those things. So you don't have to impress them by buying a lot of stock that doesn't move, it doesn't turn. You should focus on the product that turns. You need to understand which products turn over quicker so that you keep those. So that, remember, with the stock turnover, it works like this. Let's say you buy fish, tin fish. You make 30% on it. Let's say you buy it for 20 rand. You make whatever, 30% on it is how much? It's 6 rands. 30% 6 rands, yes. Then, if you only sell it after 6 months, that means for that 20 rand that you invested in that tin, you'll only make 6 rand in 6 months. In a year, it's 12 rand. But if you had invested that 20 rands in a stock item that you turn it over every month, and you still charge 30%. So that means you're going to make 6 rand every month versus 6 rand twice a year. Instead of having 12 rand, you might have 72 rand because you invested your money wisely when it comes to stock. That's where it becomes important to understand your stock turnovers. It's very, very important, especially if you are trading, you are manufacturing. You don't just manufacture for the sake of manufacturing items. Putting money in stock, it's a waste. You need to know which stock items are moving, which ones are not moving. But you need to balance to say it doesn't mean you shouldn't buy the ones that are not moving, but buy fewer or lower quantities, and you buy high quantities in the other side. So you balance. You see, you need to understand your market, you need to understand the movement, you need to understand the demand and all that. That's where you become efficient in making money. You might not be selling a lot of items, you might not have your shop full of stuff, but you might have your shop full of things that the customers are buying or buying regularly. That's where now the ratio, like your inventory turnover ratio, it becomes important. All right. And then you have your accounts payable, accounts receivable ratios. So those now, they show you how are your, in terms of account receivable. Accounts payable, I'm happy for you to extend it as long as you can. Because if you are not paying your creditors early, okay, as long as you're not damaging the relationship. But if you are not paying your creditors early, good for business, because that means those creditors are funding your business. So I'm not worried about your accounts payable ratio. You can extend it as far as you can. I mean, you can pay your creditors after 90 days. That's cool, because you will have your creditors funding your business. It's like Pick and Pay. I don't know now. The model is they pay their suppliers after 90 days. So you put the stock in, you give them stock, they're going to pay you in 90 days. Basically, you are funding their operation. Because you give them the stock, they sell it, and they keep the money. They can buy other stock and then sell in the process before they're going to pay it after 90 days. But it's because of, remember I was saying, the retailers, large retailers, averagely, they turn their stock 3 times. Okay, maybe a little bit stretched, but at most they turn it over 3 months. So 4 times they'll turn over their stock. Then with Pick and Pay, then they're not funding any stock that's sitting in their premises. They're actually making money out of it. They're like a financing institution. They're making money from people who are funding them, who are supplying them with products. That's where they are making their money, because they can turn over that stock, use the money. Before they pay you in 30 days, they might have bought other stuff that they have sold. They make 30% on it. By the time they pay you, they've turned your money maybe 3 times. And they make money out of it and they pay you. But they're giving you business, you are happy. And they are happy because they are making money from you. They don't have to they don't have to be highly capitalized. They don't have to go to the bank to borrow money, because their suppliers are funding them. That's how they understand the ratios. They understand the movement in stock. They understand their business. Similarly, with you need to understand that. So, as I said, with the accounts payable, creditors, if you can stretch them, stretch them. Please don't be proud to say, I buy cash if you're running a business. No. That's not a good business strategy. Buy on credit, because it gives you an opportunity to go buy, and then you buy, you sell, you convert the money, and then you pay people, you pay them later. It's like somebody selling you, I don't know, bread. You pay them after 30 days. So they deliver the bread, you sell it, but you're not paying them now. You're going to pay them in 30 days. So you take the money that you made from the bread, you go buy, I don't know what, Archer, whatever it is, whatever. Then you go buy it, you sell it, you turn it over, you make your profit. After 30 days, you go pay your bread guy. You made money out of the person supplying you. That's how some businesses made it their key strategy to use creditors to fund their business. So with creditors, accounts payable, stretch your creditors as far as you can. Now, the opposite must be true. With your debtors, be strict and collect on time. Because now the opposite applies. If you give your customers credit, it means you are funding them. If they pay after 30 days, you are funding those people. And you must look at, obviously, different sectors. If your sector it sells on credit, okay, you need to toe the line, I guess. But you need to make sure that you collect your money when you're supposed to collect it. Because it's like funding people. It's like funding the other business or funding your customers. So your accounts receivable turnover ratio, it must be very good. You must make sure that you reduce that. So your accounts payable ratio is accounts receivable. It's how long does it take for your customers to pay you. And then you look at that, you look at the industry. The longer your customers take to pay you, it might be a sign of danger. It might be a sign that you're not servicing good customers. Maybe you might need to fire those customers and get good customers. You must check the customers that you're funding, because there are many businesses that went under because their customers are not paying them. Because if, let's say your industry, people sell on credit, but they collect averagely within 30 days. If you collect after 60 days, that means you have your turnover for the next month invested in your accounts payable, or you're giving people credit. That's not an efficient way of running the business. Obviously, you need to take into account the sector that you are in. And then from the sector, you see where are you. But when it comes to your accounts receivable ratio, you need to be lower than the industry. Find premium customers that are willing to pay you sooner than the 30 days or whatever the industry norm is. Because the higher the amount that are sitting in your debtors, the higher investment you've put in unproductive asset. So you mustn't put money in unproductive assets like your debtors. You mustn't put your money in unproductive assets like your stock. But on the other side, make sure that you buy on credit. You push those credit terms as far as you can. I know it sounds cruel, but that's how business works. You need to know which ratio to play with. Which item where should it be? You need to know your stock levels. You need to know which product is moving, which is not. You need to know who are your premium customers. You must fire the ones that are not paying you on time, because they're costing you money. That's how you look at ratios, and that's how ratios help you to manage your business. They're not just numbers. I know we look at accounting as numbers, but now in this case, the way I want you to look at the ratios, I want you to look at them as your operational tools, as the tools that will help you optimize your operation. Make sure that you operate as efficient as you can. And okay, the last one that I will look at in terms of the ratios are your current ratios and your quick ratio. So your current ratio is basically your current asset divided by your current liabilities. Okay, to know what is current asset and current liabilities, you need to understand what is the balance sheet. And to understand the balance sheet, go back to the module on the balance sheet. We went into detail. What is the balance sheet? What are the current assets? What are the current liabilities? So your current ratio is your current assets divided by your current liabilities. So what that shows you. It shows you how liquid are you. Will you be, in a short term, be able to pay your creditors, the people that you owe? 1:1 in that ratio is good. 1 rand you have for current assets, you must have 1 rand for current liabilities, the people that you owe that you need to pay within a year. If it's 1 rand, then your current ratio minimum it should be 1 rand. But industries are different, right? And it must be going up to show that you are liquid. You will be able to pay your creditors when the amount is due. So with the current ratios, 1:1, that's where you start. But if you find that your current liabilities exceed your current assets, smell trouble. You know that you might be in trouble should anything happen, because you wouldn't be able to settle your current asset. That means you wouldn't be able to settle the liabilities that you have for the next year. And that now it can put a little bit of strain on your business, because the creditors will come knocking and you will not have the assets or the current asset to settle the current liabilities. Yes, sometimes you might find that you have big fixed assets, but you have small current assets, and you have let's say medium current liabilities. You wouldn't be able to liquidate your assets to pay for your current liabilities, because you might be solvent. In that way, they say you are solvent. You have your assets exceed your liabilities, right? It's called solvent. You are solvent. But if it's the opposite, if your liabilities exceed your assets, your total assets, if your total liabilities exceed your total assets, then you are insolvent. You shouldn't trade if you're operating like that, because you will be in trouble, because as a director you will be trading recklessly if you are trading while you are insolvent, and you need to make sure that you put it in your financial reports, blah blah blah. So you shouldn't trade if your total liabilities exceed your assets, because they say you are technically insolvent. But the one that I'm talking about now is your liquidity. You have big assets, big large long-term assets, but maybe you have smaller current assets, but you have medium current liabilities. It will affect you because you are not liquid. Because if you had to pay for your current liabilities, you don't have the current asset to settle that. So you must avoid being in that situation where your liquidity is in question. So that's what your current ratio is looking at. And then your quick ratio is you take out the stock from your current assets, and you see how does that work. As well, it must be, even your quick ratio, it must be closer to 1:1. Because if it's not 1:1, then you might not have money to settle your current liabilities. So that's how you look at the current ratio, quick ratio. Those are called your liquidity ratio. So you need to make sure that you are liquid at all times. And if you are not, obviously you need to make sure that you resolve that before you get into trouble. Because if you can wait until you get into trouble, then you might not be able to come out of it. That's how important are your current assets and your current ratios. Make sure you manage those so that you remain liquid. So that is our lesson on financial ratios. I know they sound heavy, intimidating, but they are very, very important ratios. They will help you manage your operations efficiently. They will help you think strategically in terms of how you manage your business. So put in an effort, try to understand how do these ratios work so that you can improve on your operation. That's it from me. I thank you.